Welcome to Multifamily on Zoom. Thank you so much for joining today, Greg. I am so thrilled having you. I know we see each other at conference all the time, but
Yep.
I don't know why, for some reason, I've been having Multifamily on Zoom for September will be exactly 4 years. A
Nice.
lot of people have been to Multifamily on Zoom,
Yeah.
but I don't think I have ever invited you. I don't know if you remember Arian Hudson,
Mhm.
Maurice Falogene, and
Mhm.
all these guys have been here over the years, but for some reason, I've never have you guys. How you guys doing?
Good. Yeah, I'm excited to be on. Thanks for finally getting me on here. So yeah, doing well, staying busy, staying active. So yeah, can't complain.
All right, let me introduce you a little bit to my audience. Greg, I have to say they are a family
Mhm.
that do multifamily together. His dad is not here. Um, but however, Greg founded 21 George Investors in 2013 with his father. Like I mentioned, he's not here with us. He currently oversees all operation of 21 George's existing portfolio and new acquisitions. Since 2013, he has acquired over 650 units valued over 60 million with several successful full cycle exits. He takes a hands-on approach to multifamily investing with an emphasis on strong asset management, team building, transparency, and communication. He continues to acquire both large and small multifamily apartment building and understand the benefits of having both in your portfolio. Greg is from Boston, Massachusetts, and is a big Boston sports fan.
Yep. The Sox and the Yankees are playing as we speak. So
And you head into the game, ain't you?
no, I wish. I wish.
Oh, okay.
Yeah.
All right, that sounds great. So basically, one of the questions we have for you is like, I know you guys studied together,
Mhm.
you, your dad. So
Mhm.
you have that young face, especially in the picture on your website. So
It's an
how
old
old
picture.
were you when you studied in multifamily? I
Yeah.
never asked you.
I think I was 23 when I started in multifamily, pretty much fresh out of college. I had another job for a short period of time, but started taking the educational classes with my dad, and yeah, kind of jumped straight into it and really enjoyed it. So I was excited about it and jumped right in and started acquiring properties in our backyard, mainly. And, I grew up in northern Massachusetts, so southern New Hampshire was, 15 minutes away from me, and that was kind of our target market at the time. And started acquiring smaller multifamilies there, and that's kind of how we got started. And as I learned more about the industry and gained more confidence, we're able to expand the portfolio into, larger assets in other markets as well.
Well, that sounds great. Was there a defining moment when you knew multifamily was the path for you?
Um, I don't, I think it was kind of a slow build. I think I enjoyed it right off the bat. I'm a numbers person, so going and learning the underwriting, came pretty naturally to me. I could, underwrite a deal and, it all made sense to me. The numbers, the return metrics, kind of all made sense to me. And, so that definitely kind of got me more interested and, made me enjoy it a little bit more. Um, I definitely struggled more with the communication side, like building relationships with brokers to find deals. That was a little bit out of my comfort zone, but just doing it more and more, I built more, got more comfortable doing that. And the number side always made sense to me. So I think once I kind of got comfortable talking to brokers and management companies and investors, I think that's when it kind of all clicked and came together and made me really feel comfortable in multifamily real estate and maybe want to, keep doing it for the long term.
All right, that sounds great. But I know all of you as a family. When I go to conference, I've seen your mom, I've
Yep.
seen your dad, and
Yeah.
lately I've seen your younger brother.
Yep, yep,
I think when we were at in Utah
yep.
at BEC.
Hmm.
So my thing is how I've seen a lot of parents,
Hmm.
because I am a parent myself, and
Hmm.
trying to bring their son and daughter into this business.
Hmm.
And how that relationship work between you, your mom, your dad. I mean, I always see you guys having a good time at conferences, but how does
Yeah.
actually work behind the scene? Like how
Hmm.
you guys work together?
Yeah, no, it's pretty easy. I mean, I think, there are definitely times where, it gets a little frustrating, but not often. I mean, I think part of it is because my dad and I kind of started this together. It wasn't like he had a big existing portfolio and a big company that I was coming into and he was, micromanaging me. It was more that we started this together and we're kind of learning it together and growing the portfolio together. So we're kind of on the same path. I mean, obviously he was more, just more credibility, had more professional experience, so he was definitely a little bit ahead of me, and it was a great mentor for me to have, and it was a great experience, and kind of fast tracked my education, I would say. But kind of coming in and learning the industry together, I think that just allowed us to work together right off the bat rather than me coming into something that already existed and getting micromanaged and getting frustrated. So there's none of that. And I think as my dad saw me really go all in on multifamily and going to the educational events and really learning, not just trying to buy a bunch of properties, but taking the education serious as well and learning about the industry. I think that made him comfortable being a little, more and more hands off as the years have gone by. And he's an attorney as well, so he still has, he has another full-time job. He was kind of doing real estate a little bit as a side hustle. So it wasn't like he had a ton of time to micromanage me either. And so I think he enjoyed that I kind of spearheaded it, went all in and yeah, now I mean I pretty much run, all the operations. I kind of report back to him and kind of let him, give him updates and what's going on. And obviously he gives advice, as needed and his 2 cents and deals with kind of big picture strategy. But from a day-to-day basis, it's, really, I have, I'm not getting micromanaged or anything. So that's nice. And then, yeah, I mean, it's been great having my mom and my brother involved as well. My mom manages, she does the day-to-day management on a portfolio we have up in New Hampshire and Vermont. So she's more uh, kind of a direct manager of those properties. So we just have conversations about those properties the same way I would have conversations with any, third party management we have on some of our other properties. And yeah, recently my younger brother has come on as our social media manager. So we've really been trying to ramp up our social media and get our online presence going. So it's I'm glad you're having me on your podcast. This is great. So he'll be happy. I'll have some content for him. So he's helping out with the social media and kind of marketing side of the business.
All right, that sounds great. I like it. I like it. But yeah, when I see you guys always have that harmony among you. Like I know I'll bump with your mom in
Yeah.
the ladies' room, and then we talk and
Yeah.
stuff like that. Yeah, so
Yeah.
that's really
It's
amazing.
It's great because it's great working with your family, and we try and have that as kind of one of our values of the family approach when we approach investors or when people invest with us. We try and have that more personal relationship with all of our investors as well. And communication is huge for us, getting our monthly, for all of our properties, getting our monthly updates out to investors and having a open phone line whenever, an investor calls us and going out to dinner with investors and stuff like that. So we definitely trying to expand it just beyond our family and try and keep that, environment throughout our partners, our co-GPs, our investors, all of the above. So it's try and keep that environment.
Right, that is really, really great. So I have the question for
Mhm.
you. If you had to start all over in multifamily in 2026,
Yep.
how would you start it, given your knowledge now, your relationship and experience, but
Hmm.
you had any portfolio? What
Yeah.
would your first 12 months look like?
Yeah, so if I had to start all over again, to be completely honest, I was thinking about it and I would probably do the same thing I did before. And again, I was lucky to have the guidance of my father who had kind of the original idea and the original strategy, kind of big picture strategy. I was also lucky to join a great educational program that kind of pointed me in the right direction. But I think for me, when I started, I was 23. I had no real estate experience at all. I, had never bought a single family house, a duplex, nothing. So investing in my backyard, in a market 15 minutes away from where I lived gave me a lot of hands-on experience, not only in the acquisition side, but the asset management side. That was also what I felt comfortable with at the time. You go to these educational programs and networking, the big networking events we always see each other at, and they're talking about buying 200 unit properties in, Texas or, Atlanta where you are. And, I'm from Massachusetts. I never At the time, I had never been to Texas. Like, how am I going to buy a 200 unit property in Texas? Like, I have no experience. So, getting started in my backyard was what I was comfortable with. It gave me a lot of experience and knowledge. And I think some of these smaller multi-family properties get overlooked. They can actually be very good investments in the long term. And we actually still own a lot of those original properties we bought. So I would start there, and that would be my advice to other other people looking to get into multifamily investment. If you're comfortable going after the big properties and markets, you have to fly to, by all means go for it. But there's nothing wrong with starting in a market you can drive to, in your backyard. You get a lot of experience from it. They can also be great investments. That's kind of where I would still start today, and that would definitely be my advice to anyone, looking to get started is definitely do not ignore the, smaller properties in your backyard. The thing I would probably change though is I think I tried to jump away from that too quickly. We had a lot of momentum in our backyard and scooping up these kind of like 5 to 25 unit properties, and we had a lot of momentum. We had a lot of deal flow, and I was kind of thinking, all right, now that I have this experience, I got to jump to a big property in an emerging market somewhere. Um, so I do feel like I missed out on some opportunities just in my backyard. So I think I would have even doubled down. When you have momentum doing something, keep that momentum going. You don't have to, jump to something else. So, um, so yeah, I think that's pretty much it. I would start where you feel comfortable, in your backyard, if possible, or, within, call it a 2 hour driving radius from you, find some secondary markets, um, that maybe there's still some value to be had in those markets and kind of gain experience that way.
Great. Yeah, I remember when I started with Fiverr and you guys were sponsors, you and your dad, and you guys were the type of sponsors. If you have a small
Hmm.
multi-family you could go to, and you guys entertain those type of
Hmm.
uh assets.
Hmm.
So I know, like you just mentioned it, you started in the small ones and
Yeah.
then right in your backyard. So
Hmm.
why did you start there, and when you start moving out of it? Like, I've seen you talking about the confidence you get from doing that, but why you guys decided to start right there with the small multifamily?
I think it comes down to asset management. I think asset management is another thing that kind of gets ignored in educational side of multifamily investing. It's all about, acquisition, let's be honest, acquisitions is the fun part, finding deals, that's exciting. Asset management, talking about fixing plumbing leaks and replacing roofs, like that's not going to get people's attention, but I think that's super important, and something we felt like, we're going to implement a third party management company, but we have to be able to hold them accountable. We want to be able to drive by the property, make sure they're doing what they're saying they're doing, and just yeah, hold them accountable. So that's why we wanted to start in our backyard. We still don't want to be collecting rents and dealing with maintenance calls, so we're still going to outsource the day-to-day management, but we still want to be able to drive by the property, build this, be able to meet our property manager face to face, just go up and grab lunch with him on, we don't have to get on a flight to go see our third party management company. We can say, hey, you want to grab, lunch today and talk about how the properties are doing and, drive by them. So we really wanted to implement those asset management systems and be involved in the asset management, have a very hands-on approach that we still do today. So we've expanded outside of our, I call it backyard, and into other markets. We're in Indianapolis, we've been in Chicago, we're in Baltimore, and we co-GP with people who live in those markets. So we've kind of built that into our system. If we're going to go into a market that we can't drive to, then we want to have a co-GP in that market that can act as our boots on the ground, asset manager. Again, we're still going to hire the third party management company, but we want someone to really, we've had good, bad, and ugly experiences with third party management companies. And so we want someone to hold them accountable. It's not as easy as some of these educational programs make it out to be, where it's like, oh, just put the third party management company in place and you're good. You're just, focus on acquiring the next property. I wish it was that easy, but, unfortunately it's not. So.
I tell people that all the time. The theory and the practice,
Yeah.
not even
Yeah.
close to each other.
Exactly. So,
Okay, how
mm.
would you describe today's multifamilies market in one sentence?
Ooh, that's a tough one. One sentence. I think I don't know if this is going to be one sentence, but I think there's opportunity, and I think it is what you make of it. Meaning, if you set up your team and your systems, you can kind of make your own opportunity. And again, it comes down to the asset management, your internal systems. If you're managing the property well and executing your value add over the long run, you'll do fine, So I think some people get caught up in I'm not saying don't pay attention to the market and interest rates and the broader economy. Obviously you have to stay in tune with that, but it's more where do you spend the time on the things you can control, which is the team you have in place, making sure, repairs are getting done at your property, making sure leasing is going well. So I think, those are things that it doesn't matter, you can be doing those all the time, no matter what the broader economy and the market's doing. You have no control over that. So focus on what you can control. So not
Mhm.
really one sentence, but I ran with
Yes,
it.
yes, yes. Well, what's happening behind the headlines that you think most investors don't see? Because I know you go to a lot of those conferences. I mean, in fact,
Mhm.
that's how you and I start getting, you
Yeah.
know,
Mhm.
friend with each other because we was
Mhm.
like, every time I go to a conference, Grace is there, or Susan's
Yeah.
there.
Yeah. Um, yeah.
So, I know on Thursday night,
Mhm.
in New York, the
Mhm.
board of the city of New York, their
Mhm.
board decided to freeze rent for 2 years. That's the first time ever that ever happened in New York. And we've
Yeah.
seen those freeze going on to some of
Mhm.
those big cities and a
Hmm.
place like New York. And I think Boston is not far because Boston is one
Hmm.
of those places that is very, very expensive. I was in Boston in 2024. I spent the whole summer there. I've
Yeah.
seen a different Boston than the Boston that I knew.
Yeah.
So what you think, even though we're not getting into that kind of, news, but
Hmm.
what do you think that most investors do not actually see?
Yeah, I mean, I would say you have to be really in tune with your local market. So you need to, if you're investing in New York or, some of these major metros, they're going to have more, uh, you know, laws or, you have to be very conscious of that. Is rent control, in Boston, rent control was going to go to the ballot, but then it got shot down. So now it's not going to be on the ballot, but it's one of those things that's always kind of hanging over your head if you're in Boston. But that doesn't mean, it's not like no one's ever made money in Manhattan or Boston. There's a ton of wealth in these cities. People have clearly made money in these cities. But you just need to know it. You need to know what's going, and that goes for any market. If it's Southern New Hampshire, if it's Atlanta, Dallas, Indianapolis, wherever. I think it comes down to having a focused approach and really honing in on what's going on in your local market. If you just read the headlines, oh, there's a big job amount announcement in XYZ city, obviously that sounds great, but do you know the local, laws and, everything kind of going on behind the scenes? So I think obviously there's stuff to pay attention to from a national level, but then you really need to dig into the market you're investing in as well and understand what's going on in that local market, local economy, just beyond the big announcements that sound great. Oh, a huge, huge plants coming in. There's going to be a ton of jobs coming in, but you got to dig deeper than that. And every market's going to be a little bit different. So you just need to get to know it and understand where the opportunity is in that market. We invested in Chicago back in 2021, 2022. We had a few deals there, and they went, I'd be pitching the deals to investors saying, "Oh, this deal's in Chicago," and they'd look at me like I was crazy. Why are you investing in Chicago? Like that's, terrible. But the deals we did great. Again, we had great boots on the ground partners. Everything went well. And if you look now, Chicago has some of the highest rent growth in the country. So it's building your team in the market and understanding what's going on locally rather than just getting the broad headlines, as you mentioned. The high level headlines aren't going to tell you everything you need to know. So yeah, I mean, I don't know. Does that answer your question, or did I go off on a
Yeah,
tangent there?
definitely. Yeah,
Yeah.
definitely. Because I think people try to focus, like you're saying, in the big headlines. But at the end of
Yeah.
the day, it all comes to your team and the
Mhm.
strategies you guys develop.
Yeah.
Because things going to happen. There's gonna be opportunities everywhere you go.
Hmm.
At the end of the day, is try to understand your market that you
Hmm.
are in and making sure because partnership is huge.
Hmm.
That's
Yeah.
another thing people don't understand. When you partner with someone, you have a co-GP,
Hmm.
and that's what they say you go to bed with someone, you need to know that person.
Yeah.
And having each other's trust and able to build that partnership and you guys reach each other the right way. Because
Hmm.
there's gonna be time when things are tough, and
Yeah.
that's when you're gonna really know your partner
Hmm.
got your back or you got your partner's back
Hmm.
and the conversation still can flow because whoever's standing ahead of you, in front of you, you guys need to find a way to find a solution and
Hmm.
get through that moment or that situation.
Yeah. Yeah,
So
exactly.
I
And,
think
yeah, another kind of point is, everyone kind of shies away from maybe the blue states or the blue cities because there's not as much growth going on there. But in some ways, the regulations in those states and cities help because there also wasn't a huge supply influx in those markets, which is why the Sun Belt's getting hit hard right now because there's so much supply going into those markets where some of these other cities with maybe a little bit more regulation and stuff, there wasn't as much supply. So you're seeing the rents actually growing more there now than than some of these, high growth markets. So again, it's kind of peeling back the layers a little bit, and understanding the full picture. And then also, I'd also say I think everything happens slower than we want to believe. I think there's a lot of buzzwords that come out. One that a big one that I always think of is like the survive until 25. Everyone was like, oh, just make it through 2023 and 2024, and interest rates are gonna magically go back to zero in 2025, and everything's gonna be great in 2025. And now we're halfway through 2026, and we're kind of still in that same spot. So I think when someone gives you a prediction about a hard date, like, oh, now 2027 is going to be great. It's like, all right, it might be 20, 27, 28, 29. It's going to happen more gradually and slower, and you kind of have to be patient and have a longer term perspective on the market cycles.
All right. Hey,
Mhm.
now I have a quick question for you. I'm not trying to trick you, but I'm trying to get in the brain of you are a sponsor. I'm trying to get in the brain of students that
Mhm.
would like to invest into multifamily right now. If
Mhm.
someone handed you 100K today and said, build wealth,
Mhm.
what would you do with it? Would
Mhm.
you buy multifamily? Would you syndicate? Would you partner? Would
Mhm.
you buy more education? Would you buy smaller properties first? Would
Mhm.
you buy locally or invest out of state?
I would, um,
But that's all you have. You only have 100K to start
yeah.
off and then get it from there. Build your
Yeah.
wealth.
Yeah, I would. Well, I mean, the educational side of it is, if you have the education already, then, I'd continue to go to the events, but not spend as much money on the education. If you don't have the education, then I think it's a requirement. You have to spend the money on the education. Um, but outside of that, having 100,000, I would definitely try to focus on a market drivable in driving distance, because again, you kind of have to think of the enterprise value and the big picture. Like, if you have 100,000 and you're going to invest in a market you have to fly to, like, how much are those flights going to cost? You have to get a hotel for a week to stay there. So that 100,000 is kind of coming down and down. And you know, you don't just travel to a market once and get to know it and get you don't just walk one property and close on it. It takes some time. You need to fly there a couple times. You need to spend time there. So, you're gonna kind of see that 100,000 become, 90, 80, so focusing on your backyard that you can drive to, it's much easier to get FaceTime with brokers, learn the market, drive the streets, understand, you know, um, what side of the tracks to be on, what market, what neighborhoods are good, what neighborhoods, you want to stay away from, and get that boots on the ground experience in the market. So I would certainly try and identify some submarkets. Again, I can just kind of speak for myself, being from Boston. Southern New Hampshire is a great submarket. So and we invested in Hartford, Connecticut as well. So we kind of just drew a radius around New England really, and said, all right, some of these smaller cities, throughout New England, we're going to focus on those. So I mean, if you're just getting started out, that's what I would do. And then people get nervous too. I mean, certainly when I started out, no one wanted, you go to these events and I'm saying, oh, we're investing in New Hampshire. And, you kind of get that, a lot of people look at you like you're crazy, like no one's investing in New Hampshire. But once you get in tune with your local RIAs, and I mean, there's people investing everywhere. You can't go to someone from California and ask them to invest in Southern New Hampshire, but there's plenty of people in Boston investing in Southern New Hampshire. So you just kind of need to get yourself in front of the right people. If you're looking for investors, to supplement your, 100,000 as well, which depending on the size of the deal, you most likely will. So, but yeah, I mean, I would certainly, I think starting in your backyard, especially if you're just starting out, is a great way to get started, because again, it gives you that experience getting FaceTime with brokers, and then also asset management experience, overseeing the third party management company, you can drive by your property more often and just kind of see how it's going. So I would definitely, recommend that.
All right. Fast forward, let's get into fighting deals. In 2026, where are the deals actually coming from? Brokers,
Mhm.
direct to owners, distress sellers, bank, loan maturities.
Mhm.
Where should investors spend 80% of their time looking for opportunity right now?
Mhm. Um, so I've always gone through brokers, to be honest, and just really spending time with brokers, building relationships with them, and kind of letting them eventually bring the deals to me. And the more time you spend with them, the better relationship you build. It does take some time, but they'll start giving you kind of the pocket listings and I think more and more right now we are seeing a little bit, the pocket listing thing kind of went out the window in, call it 2021 to 2023 because every seller was like, no, throw it on the market, push it out to everybody, and let them bid the price as high as possible because people were paying. But now some owners are getting a little bit more in trouble. Maybe with their loans and stuff. So they're kind of telling brokers like, hey, we want to sell this, but just we want to get it off the books. Let's sell it quick. Put it out to a few people and let's try and sell this. So I think that's slowly coming back a little bit more. And that's kind of how I've always done it. Looking back, maybe I should have put more time and effort into direct mail campaigns and other ways to find deals. But I've always had relatively good success with brokers and stayed busy enough on the acquisition side. I never really explored too much into, other ways to find deals.
All right. The money. We all need money, right? Money has changed dramatically. How should investors think differently about financing today? Fixed versus floating, bridge loan, agency debt, sellers finance. People love to talk about sellers finance, but make it sound like you just walk out there, a seller gonna
Yeah.
just let you take over his property.
Yeah.
So what financing mistake are still killing deals, in your
Yeah,
opinion?
well, I think the floating rate debt was the big one in kind of I guess we can call it the previous cycle. Again, the 2021 to 2023, a lot of people were putting floating debt on stable properties just to maximize their leverage, and make the deal, work a little bit better. But I think if you're putting floating debt on a stable asset, that there isn't significant value creation on the property level. I don't know, it's definitely very risky. You're kind of trying to make the deal work, and we saw a lot of that again from 2021 to 2023. I think people have woken up a bit to that, and maybe we're not seeing that quite as bit. A lot of people are kind of taking a step back from the floating rate debt, and I definitely agree with that. I, you know, take a very conservative approach to multifamily investing and just fixed rate always spoke to me. I just want to know what the rate's going to be. I don't feel like dealing, it's just another thing to think about. So I just always I would stick with the fixed rate. I would always go fixed rate. If you're doing a heavy value add deal, it's 50% occupied and there's a ton of work to do, a ton of value to create on the property level. I mean, you're going to have to go bridge financing anyways, and a lot of that's going to be floating. So there's a case for that there if it's a heavy value add deal. But a stabilized deal, I would do fixed rate and just lock it in and don't even think about it after you buy the property. And so, yeah, I'm pretty simple when it comes to financing. I just do fixed rate, a lot of agency loans for the properties that qualify for it. Um, some of the smaller deals we've done, just we do bank financing. Obviously you do need to personally guarantee it, but if you're comfortable with it and you have a good team in place, you're confident you can execute, the business plan for the property. I think bank financing can be it's certainly easier to deal with banks than it is agency. You can build a personal relationship with the regional bank, and
True.
we've had a lot of success there. So I wouldn't shy away from bank financing if you're going after smaller deals. Again, if they qualify for agency, I would do agency as well. Um, and then, yeah, seller financing. I mean, if the seller financing makes sense, it's great. It's awesome, but you just have to be cautious that sellers will give you uh good, a good interest rate, but they'll boot, just so they can sell the property at a higher price. So you just still always want to think about the basis you're getting in for. They're trying to bump up their exit price and give you a good interest rate. So you just need to be cautious of that and make sure you're still getting in the property at a good basis. So,
That's right. Yeah. Underwriting, which is your thing.
yeah.
What assumptions have changed since 2021? Is it rent growth, maybe insurance, taxes, vacancy,
Hmm.
exit cap rate? What number do you think investors are still underestimating?
Yeah, I mean, rent growth is definitely, again, I've always taken a pretty conservative approach, which I think has led me to miss out on some opportunities that, probably would have been great, properties to buy. But I've always been conservative with rent growth, and I think you should continue to be conservative. Anytime you see a rent growth going to over 3%, I'd second guess that. Especially right now, I think rents obviously aren't growing as fast as they used to be. Um, again, insurance is increased everywhere. That's going to be higher. But a lot, insurance, you can talk to your insurance agent and they'll give you kind of an idea of what your insurance is going to be. I would say operational cost is the biggest one where people try and, like repairs and maintenance, contract services, unit turnover expenses. People always try and like, oh, let's just decrease that a little bit and, to make the numbers look a little bit better. But um, it always costs more to operate a property than you think. So I would, especially if you're in the Class C value add deals, I mean, your repairs and maintenance there's going to be a lot of repairs and maintenance, and your contract services are going to be what they are. You don't want to be like, oh, well, we're going to not pay our landscaper. It's like, no, you gotta keep up, the property. So I just think you need to be realistic and honest with yourself when you're underwriting a deal as to what those operating costs are going to be, and not just reduce them a little bit to try and make the numbers look a little bit better.
Yes. If protecting investor capital is priority number one, what
Mm.
keeps you awake at night today?
Ooh, hmm. Um, Yeah, I mean, I guess just execution of value adds, again, that's kind of the ongoing thing. Again, I mean, all of our loans are fixed rate. So on all of our existing properties, uh, they're all fixed rate. There's no concern about interest rates going up and getting hurt there. So I think just ongoing execution of the business plan and the value add strategy and leasing up units. Especially in some value add deals that we have going on. Just kind of like, hopefully we can, get the property leased at the rents we want, and hopefully we can keep maintenance kind of in check and keep the team, the on-site team motivated to, do a good job on a day-to-day basis. So I think a lot of it comes down to, you know, the boots on the ground, upkeep of the property, and asset management of the property.
All right. What ways most investors completely ignore?
Hmm. Um, yeah, I mean, again, I think I'm going to sound like a broken record here, but I definitely again, I take a hands-on approach to asset management and taking care of the properties. I think you go on LinkedIn, you go to these networking events, and everything's about the economy, about demographic trends, and just kind of big picture, AI, like how is AI going to affect, the industry? And like, I don't know, at the end of the day, I don't think anyone really knows, to be honest. So, and then they kind of skim over, the asset management. They don't really get into managing your property, executing your value add, and how important that actually is. And so I think, that's a risk. Anytime you buy something, you have to maintain it, you have to improve it. And that's the thing you can control the most, and that's where most of your attention should be. And if the economy does change, we go into a recession or whatnot, the properties that have the good on-site management, the good asset managers that are attentive and on the ground and, paying attention to their properties, those are the ones that are gonna be able to climb out of, anything that the economy has to throw at it. So again, pro sound like a broken record, but I think the risks are, um, the biggest risk is not maintaining your property or not having your third-party management company maintain your property to the level they should be. And I think that does get skimmed over a lot in educational programs and big conferences. So I think that's the biggest risk and the biggest risk that you have direct control over as well. So
All right. Let's dive into the two letters or the two words of the era, artificial intelligence.
mhm.
A lot has changed. How are you using AI um to find deal, underwriting? You just mentioned asset management, which is huge.
Mhm.
Investors communication. Do you think investors who ignore AI will eventually fall behind?
Well, you're talking to the wrong guy here because I don't use AI at all. So I think people, a millennial, they probably think I'm ahead of the curve, but I don't use any AI. So maybe I'm falling behind. I don't know, but I don't know. I answer my own emails. I call people myself. So yeah, I've not much to add about AI.
I see. Okay. You plead the fifth on this one.
Yeah, yeah.
If you were brand new, I know many people watching today haven't bought their first apartment yet. In fact,
Mhm,
yesterday I spoke to a student, a former student. I think she's coming back. She came to UP. Um, and she was telling me she met a partner at UP that has small deals already on his own. What
mhm.
would you be, what would be the exact roadmap? I'll walk us through month one if you take you can because we don't have a lot of time left. But what would you do right now if you were brand new and you get in your very first apartment?
Um, yeah, so I mean, if it comes to partner, do you mean kind of on the partnership side, if you're going to partner with somebody and get involved in a deal?
No, I said if you were getting your very first apartment, what would be the exact roadmap that you would follow
Okay,
for getting your first part in the in
mhm.
month one? What would you do first? Month two, what would you do?
Yeah. So yeah, month one, I would, you know, go meet with the brokers face to face, put some time in with whatever market you kind of have identified as where you want to acquire properties. Um, meet with the brokers face to face. I would build my team in the market, um, start talking to third-party management companies early on. Don't wait until you have a property under contract to start talking to third-party management companies. I would start talking to them as you're talking to brokers as well and kind of setting up your team in the market. If you are going to have a partner on the deal, start setting up weekly calls with them so you can really understand how they work, how you work, how you're going to work together. So set up that team kind of early on. And even though the acquisition might not occur for a few months, get those systems in place, get your team in place, make sure you all have similar values and like each other, so you get along when you work together. I'd also start talking to lenders, whether it's direct lenders or mortgage brokers, to kind of understand what your financing is going to look for, what you can qualify, understand if you need a sponsor, if you're looking at a deal that you might not qualify for, build a relationship with that sponsor. Again, starting day one, start building that relationship with the sponsor. So, yeah, that first month is just putting that team together and making sure you have all the pieces. Same with the equity. If you're confident you can raise the equity, then that's a role you can play yourself. If you think you're going to need help raising equity, find that team member that can raise equity for you. And kind of give them that role. So put all the pieces to the puzzle together of the team together, as quickly as possible, um, and make sure you all kind of work well together. And then yeah, just spend time in the market, start underwriting deals, really get to know your market. Don't just underwrite one deal and think it's great. You can't understand if a deal is good if you don't understand your submarket as a whole, because you have to understand what the competition's selling for, what rents that they're getting. So really dig into the market. And get to know that, get to understand what, price per unit properties are trading for, what rents, class A, B, C, are getting. So do all that research, really dig into your market, and be focused on your markets too. Don't jump around to too many different markets. Focus on just one or two markets and really understand what's going on in those markets and build your team in the market. And then, yeah, I mean, then hopefully eventually you can get a property under contract, and all that groundwork you've put in with putting your team together. You have a mortgage broker or a direct lender that you can talk to, and they'll give you, a financing quote. And you have your sponsor, you have your person who's going to help raise equity, and that kind of, comes all together when I guess get the deal under contract.
All right. Let's talk about capital raising. If nobody knew your name today,
Mhm.
um, how would you raise your first $1 million? Would you spend more time networking, building content? I know you don't build content. Meeting brokers or meeting investors? What would you do?
Yeah, I mean, I think it all has to be going on at once. So that's why if you have the time to do it yourself or you have the confidence to do it yourself, you can. But that's why, partnership is such a team game, team sport, or syndications are a team, sport. So you can bring on a partner if need be, to help, potentially raise capital. But I would definitely start by building, some type of online presence just to give yourself more of a professional look, create a website, maybe do a LinkedIn page, maybe some other social media pages, and start putting out some content. It doesn't have to be daily, but start getting some content out there just to give yourself a little bit more credibility and just show professionalism and show you're kind of committed to this industry and committed to, kind of growing something rather than just trying to do one deal and, go off into the sunset or whatnot. So definitely start with the online presence, but then also just the networking. I mean, I don't think there's any way around it. You have to get in front of people, you have to get in front of investors, you have to meet them face to face, build a relationship with them. Unfortunately, a lot of investors aren't gonna invest with you immediately. You have to spend time, building that connection with them, and it's gonna take some time. So I think going to networking events is, kind of there's really no way around it. Whether it's national networking events or just kind of local, meetups or RIAs, just kind of get out there as much as possible. And then friends and family as well. I mean, I think starting out, friends and family is the biggest. Um, those are the people that you already know. Hopefully they trust you, maybe they don't, but those are probably going to be the first people that are going to, invest with you. So, everyone comes from a different situation. Some people might have the friends and family with the means to invest. If you don't, then, you definitely need to get out there, um, you know, get out there networking and meet people or maybe partner with somebody who can help, raise money, a little bit quicker. So
All right. So today we're gonna do something fun. I really enjoyed that session with you, Greg, and
likewise.
it is something fun. So you're gonna tell me, answer the first thing that comes to mind: cash flow or appreciation?
Um, I'm a cash flow guy. I gotta say cash flow. Um, because yeah, I like cash
Okay.
flow, but I think
Class
cash flow
B,
is more predictable. I would say cash flow is more predictable, and then hopefully in 5 years, your property is going to be worth more, and you get the appreciation on the back end. But I like the predictability of the cash flow.
all right. Class B or Class C?
Um, my whole portfolio is Class C, so I'll have to say Class C. But I mean, I think they're both good. Class B would be nice. I think that's probably a little bit easier from a management standpoint.
Dallas or Atlanta?
What was that?
Dallas or Atlanta?
Boston.
Boston is not in there.
I would say Atlanta. Again, I don't know. I haven't invested in either market, so I don't know them intimately. But again, it comes down to locate. Like I'm on the East Coast. Atlanta's a shorter flight for me. So if I had to pick off the top of my head, I'd go Atlanta. But yeah, I don't know them, too intimately.
All right. New development or value add?
Again, I've always done value add, so value add.
Okay, I think there's the next question of what you're gonna pick. One large property or five small ones?
Um, I guess I mean either's fine. There's no wrong answer, but I think five small ones can give you a little bit more flexibility in you can sell off one and keep four, or a little more flexibility there. So again, I'll stand up for the small properties here and go with the five small ones.
That's why, yay! Jerry said, yay! I can see Jerry in the back. Okay. Best real estate book.
Best real estate what?
Book.
Oh, book. I need to read more of them, to be honest.
I thought
Um,
you were gonna say Dave book.
yeah, Dave's book. I mean, emerging markets. I'm definitely more of a business, read more, kind of general business books more than just real estate specific. Um, so the
Okay, Ben, best business book then. Best business book.
um,
That was my next one anyway.
yeah. Now that I'm on the spot, I'm blanking on the name, but the EOS. I think I have it right here. I don't know, I can't find it, but the EOS Good to Great is good. And then the book before that, whatever the first one is. So
All right. One habit that changed your career. One habit that you start, implementing in your life that totally changed the game for you.
um I don't know if there's one. I think just consistency, underwriting, giving myself weekly goals or weekly metrics to hit, underwrite X amount of deals a week, talk to X amount of brokers per week, um, talk to X amount of investors a week, and just making it attainable. Not, I think early on I was, I want to close on $20 million worth of real estate, this year. And you're not always going to hit that, but if you simplify your goals and make them shorter, just a weekly, I want to talk to this many investors, this many brokers, underwrite this many deals every week, the larger goals are gonna, you know, be hit in the long run.
All right. We have 3 minutes to end this. The closing question. If you could give one piece of advice to every real estate investors watching today, what would it be?
Start with what you're comfortable with and be focused and kind of have a little bit of a longer term perspective on real estate investing. I think a lot of people will pick a market to invest in. They'll underwrite a few deals there. Those deals won't work. So then they jump to a new market, underwrite a few deals there. Those deals don't work. Pick a new market. Just focus on that first market. It's going to be a little difficult no matter what market you're looking in when you're starting out. So just stick at it with that first market, get to know all the players in that market, and it'll pay off in the long run. And then, start with what you're comfortable with. It can be a 5 unit in a market a half hour away from you, 100 units in Dallas, whatever you're comfortable with, start there. But you certainly don't have to go for the 200 unit property that's 100 miles away, or 1,000 miles away from you. You can start with what you're comfortable with, and build from there.
That's right. So the final question I'd like to ask you I'd like to end with one memorable question. If everyone watching today only remembered one thing from this entire conversation, what would you want that one lesson to be?
Mm. Um, I would say have a focused approach. Make sure you have a good team in place, that's going to support you and complement you, and focus on what you control, what you can control, which is most of the time kind of the management of your properties, and really mitigate that risk. So yeah, definitely have a more focused approach to the acquisition side. Build your team up front so you have a good support system and a good team to grow with, and then focus on what you can control rather than getting too caught up in what the interest rate's doing and what the economy's doing, stuff that you can't control. So focus on what you can control.
That's right. Forget about the noise.
Yeah, exactly. Yeah.
Well, thank you. Thank you so much. You have no idea how much I enjoyed this
Likewise, it's
conversation
been
with
great.
you and having everybody here. And next week, guys, we're not going to have a meeting because it's 4th of July, and I will be in our park, the RV Resort in California, because we're having an event for 4th of July. I mean, it's 250 years, so we're definitely going to be there with our guests. But the following week, which is the 11th, we're going to have Tyler Raymond and his dad. Next time, you have to bring your dad.
I will. As
And
long
his
as I'm
dad,
invited
Mark,
back.
yeah, his dad, Mark, and of course, they're gonna be talking about real estate, the asset class, mostly focused on RV resort. And yeah, it's gonna be a really fun conversation having them here. And thank you, everyone we have attended. I know of all the places you could have been, you decided to be here. And also follow my YouTube page. I mean, we're doing a compilation of every single session. We're putting them back into the YouTube page. I've been really lazy with that. Never really work on it. I mean, in September, it's going to be 4 years since I've been hosting this. Um, and I remember the first people who start coming here. Of course, most of them were from our mentor to begin with. But again, let's see you guys next time. Follow me on LinkedIn. And thank you so much, Greg. Greg, your information, I know, do you still sponsor deal from student? Do you want to put your phone number there and your email?
Yeah, you want me to put in the chat?
Yes. And remember what Greg said, if you are in a market, he like to partner people in their own market because that is the type of philosophy that they follow. Um, if you have something in your market and you're looking for someone to come with you, uh, his team will definitely look into it. You guys can reach out to them, and he just put his information in there. So go ahead and reach out to him. Okay, guys. Thank you so much, Greg. And thank you,
Awesome.
everyone.
Thank you,
Have a
Sirius.
blessed afternoon. Bye, everyone.
Thank you, Sirius. Have a good one.
Greg, nice to meet you again.
Hey, Jerry.
Thank you. Bye.
Thanks, Jerry. Have a good one.
Bye.